Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only, so if you are entertained, please like and subscribe. So I'd like to talk to you a little bit about margin because my opinion on it has been evolving a little bit recently, but also mostly the same. So when I first enabled margin, and before the last failed sale attempt on my condo, I was using margin for these high income ETFs because MSTY had 100% distribution rate. The margin maintenance was 25%, and my margin APR was like 6%. Who cares about a 6% fee if you're getting 100%? So that was working well for me, but then I entered into that sale and I was having to come up with $50,000, and I was like, okay, well, we won't have margin and we'll use margin withdrawals. So then I stopped doing that. And then when I was waiting, I discovered that if you do options collateral, then you don't get charged interest for that. So then I'm researching and experimenting, and so there are certain types of option strategies that I would use margin with. And also MSTY decided to change, or Robinhood decided to change MSTY's margin maintenance from 25% to 60%, which kind of changes the plans over there. So cash secured puts, those are fine with margin as long as you don't take 100% margin out, because in the worst case scenario, like the price of something is $30, I put in a $25 strike price, the stock goes down to $24 and I get assigned. Well, I still own this stock and it's a lower price than when I put the strike price in. So I don't mind owning, or at least in theory, I've done the research and I don't mind owning the stock. And now that I own it, I can do the dividend wheel, which means I'll start doing covered calls on it. And I did this strategy with Bitto. So, my only issue with this and cash secure puts is that I only have, so much money in my bank account here, and it's gone up lately. And so I don't really want to have a $150,000 contract out because I don't have that much money. So that was one of the struggles where I'm looking up and trying to find companies that are cheap but also worth investing in. So one of the things that people do with margin that gets them in trouble is that they take out too much margin. They leverage themselves too much. So I try to keep it at 50% margin. Right now I'm at less, but I'm not in danger. Like if I can lose, $10,000, I don't know if my account will go down $10,000 at any one time. So I think having less than $10,000 out on margin, this whole MSTY being at 60% is really messing up my margin rate. What can I say? Anyways, another thing that you could do if you don't have enough money are leaps, which you all know that I accidentally bought the SPY leap, and then I purposely bought the SoFi leap. And with that, I want to use cash and not margin, because it's a gamble. I'm gambling that a year, and because these are they're expiring, 2027, mid 2026. So I'm betting that a year from now, when I go to roll it over, that the stock market will be higher and I'll be able to make a profit from it. but I don't get a profit from this portion of the leap until I sell it again. So that's why I would like to purchase this in cash. And then like this SPY call here I rolled it forward because it was in danger of being in the money, and I put it far in the future. And then of course the SPY went above it again, so now I'm trying to scramble to get this. I get credit for it, but not as much as I would like in general. But this is why we pay things like Roundhill to do it for us, because I mean they would just buy to close and reopen it, and it won't be a big deal. Like overall you would have profit, but I would rather try to just roll it and get profit, and then get back on the regular cadence. So like there are ways to fix your options that don't cost you a lot of money, but options are actually kind of expensive. They cost 3 cents per contract to open it, and then because my account is small, they forced me to buy to close or roll over, or I have to actually send them a support ticket and say do not execute. So I'm trying not to do not execute too often. It's more advantageous to roll it over and eat the 8 cents, or however, it might be 10 cents, it might be $1. Like it just depends on how much intrinsic value the option has left. But for leaps, I would prefer to start off with using cash, and then the calls, like I'm either making profit or I'm not, but either way I cannot be assigned because that's a pain in the butt. So that leaves us with credit spreads, which is something that I've started to experiment with, and I have a mixed feeling about using margin with this, because my attitude so far has been like, in the worst case scenario, I need to be able to make an income, even if it's a mistake and I get assigned. Like if there's no way for me to make a profit from it, if I lose, then I'm not that interested in it. However, because you can roll your option, you could use margin, but I would prefer using cash, or at least having the cash on hand to cover any lost bets, because it's less devastating to say like, oh, let me show you, and let's use SPY, because I feel like a lot of people do start out with SPY options, and I don't agree that like if you don't have $60,000 you can't participate in options. Like that's a little silly. I do think that you would be better off if you're trying to start with options that you do paper trading for at least a little bit. That way you can get the hang of it without actually putting money up. And I think that there's actually websites that you can do this. So like we'll just keep this at a $1 spread, which means the most that you can lose is $1. So basically you can put it really, really close to the money, and you say like, okay, I only have to make 2 trades to get that $100, 100% return on income. Investment, yes, ROI. But I usually scroll down, and I'm usually do it here. So I'm like, okay, I really don't think that the SPY is going to go down by $7 today for any reason. But I mean, it could be wrong. And it does cost 3 cents to open it, and 5 cents usually per share to close it. I mean, it could be as little as 1 cent per share to close it. So I could get, $13 of profit, and then I spend $1 to close it, or $5. So I would probably do it here, or like here, or or both. If it's only $100, I could do it here and here. But the bet here is, can you do this 10 times and not get margin call, not get assigned? Because if you can, then you have your $100 back, and then your, house money, and you can just continue doing that, and then eventually you're going to lose. But like, if the price is right now is $5.98, you put out a put spread for $5.91. When it gets down to like $5.93, you roll it over. It's more expensive than usual, but you're not losing $100 usually. Just putting that out there. But then, like, let's go to my favorite, because most people don't trade in this, and it's a little unusual, and it's very, very volatile. Not even gonna lie. We go here, and we got this, and then this just started doing weeklies, so not all of them are filled out yet, but December 20th had already existed. So we're saying, like, I'm going to have a $1 width, which is $100 I'm putting up. So you could make a bet and say, $1.30. Okay, well, if I lose this bet, the most I could lose is gaining $30. Or even further out of the money, and you're like, okay, well, the most I could lose is gaining $115. And this is usually the least that you could do. So it's like, you could do $2.90 or whatever. And like, there's really no reason why I wouldn't, since I wouldn't mind owning MSTX anyways. I just don't have $14,000 to do a cash secure puts. But it makes more sense to me to, if I'm putting up $100 each one, and I do it at various strike prices where, like, I could make $120 from my $100, $125, and I could just do it up and down and not lose money on any of these bets. I think for me, this seems relatively safe, but it's also pretty atypical, because if you look at MSTX, it does have like a 400% IV, and a lot of people are not comfortable with that. But I do think that if in a single bet for your put, your worst case scenario is still in the positive, that it's kind of okay. I mean, don't take this as advice to do this, but like, if your worst case is you gain money, then it's not really all that risky, is it? And like, what I did was I did a cash secure puts at $65, and I made like $400 something from it. Like, that's fine. But I could also, that was $6,500 that I could have 65 contracts and put it out here. Like, I feel like you just have to do your math and figure out how far out you can go on these things. And, I think it's more typical to say, like, this 58 strike price, like, MSTX is a 2x, so it really could go down to $58, but you only have to do this bet twice to make money from that $100, or at least to be like return of investment. So I think that's why I might prefer to look at leveraged things that have higher IV for put spreads, because if I have to make less bets to have my return on investment, then it's less risky for me to lose that $100. And I mean, yeah, if there's a chance that if it's like, 55 cents, or if I'm doing the SPY puts, I want that to be in cash because I'm still losing money. It's still a bet, but I'm not going to lose the money and then also still owe Robinhood money to do that. That's a little insane. So, yes, once I have my credit cards, which are 0% APR, but in January I'm going to start using margin withdrawal to pay it off, and then using my premiums and distributions to pay it back, and then just like keep paying off $1,000 at a time until it's done. Once I'm done with that, my margin is probably just going to be with high income ETFs, and I'm probably going to stop messing around with doing my own options because it is gambling. And like when the funds lose their bets, you still own the shares. So the price of the share will go down, but you're still going to get money. And that's just how it works. And it turns out that doing options is expensive, and it's not called NAV erosion, but you're going to experience NAV erosion if, you have your SPY put spreads and you lose, and then, you lose 100, like if you do it the fifth time and you lost $50. Okay. Well, if you had put it into XDTE, and, they're losing their bets all the time, but they have millions of dollars to make it up. Like, maybe you put it in at $52, and today it's worth $48, but you're still going to get paid about 25 cents on XDTE. And then it'll recover, maybe, someday. And, like, high-income ETFs are for income, and they're not for growing. I mean, it's nice when they're not, like, constantly going down, like Bernie, for example, where it's like, well, now it's at, I don't even know what it is right now, but it like went from $20 down to $5. Like, that's not amazing. But if they can find support at whatever level, and you can get paid and not have to worry about strike prices or, getting called and doing all this stuff, then that would be my real recommendation, is just to stick with like your YMAX and your YieldMax and Roundhill and Neos and all these other funds that your JEPI and JEPQs of the world, like, yeah. But for now, I think I just really do need to pay off this debt, and I would rather not. Like, I would really love to be able to grow my portfolio and have that growing as I'm paying off, using this portfolio to pay off my debt. So like my cash, for the most part, that's what I'm going to be using for next year to do options, my own options. And then, like, every month I'll be adding $2,000 to this. So I'll be getting more and more cash. I'll be able to do more options. And then at the end, like, you only need, like, $8,000 to do a LEAP contract. So if I really want to do a LEAP contract, I could. Or I can find leveraged ETFs that I only need to do, like, 2 or 3 bets on and do cash secured puts. Or I can do... did I say cash secured put? I can do put credit spreads on unleveraged things that are too expensive for me, or I could do cash secured puts on stuff like SoFi that's, less than $20, and it's not as much of my I do like using option collateral, and if I have the money, using cash secured puts to get into positions, because I don't get margin interest until I get assigned, and then I can use the premium to pay to go into a high income ETF, and so, like, no matter what happens, I'm getting paid. So that's just my thoughts on margin right now. I don't mind using margin and getting charged for margin, but because there were circumstances that made me like retract my margin, now I'm changing my strategy and I'm looking forward for the future, and I'm going to do this temporarily, and we'll see, mid next year after I've paid off my credit card, what my risk appetite is and how I'm feeling about things. So what is your attitude towards margin? Are you using any for your high income strategy? And I will talk to you all later. Bye.